So now Andy Whitesitt will wrap up this year's conference with a look at the future of the industry. Andy is Vice President of Business Development and Customer Services for ACES. Andy joined ACES in 2003 and has held various positions in power and natural gas, most recently as Vice President of Natural Gas and Fuels. He leads the development of new member and customer business for ACES and is responsible for ensuring service quality. Andy will conclude this year's conference with a discussion on what the future holds for the energy industry and his thoughts on what ACES and its members and customers can do to prepare. So please welcome Andy Whitesitt.
Thank you all. Thank you for those who stuck around. It's clear after the past day and a half that there's so much risk and uncertainty that we have no idea where we're going, and I have no recommendations for you, so we'll just call it a day. I'll attempt to give you some things to think about. Now, again, we did see a lot of where we have been and where we are today. We've seen some forecasts on where we're going, and I want to challenge you. I've got two goals here today. The first one is hopefully to keep you in your seats for about 30 minutes, and I won't drag this on for too long, but I'm going to keep it high level. But two, and more importantly, is to challenge you to kind of keep your mind open. So we hear a lot of, this is what the world is now, and this is what the world's going to be. And I just want you to think as you look forward to your future power supply in the industry, what challenges might lie ahead and what opportunity those might create, and try and keep an open mind. Because if you look back, this is a sample of a ACES member portfolio in 2008. This at one time had 2008 written on it. I don't know where that went, but this was 2008. So that was about 10 years ago. So we're making plans here for the next 10, 20, 30, 40 years based on information that is hard to figure out. And when you just look back 10 years, we had a totally different outlook and a totally different portfolio than we have now. 10 years ago or so, you might recall that we were running out of natural gas in the United States. So natural gas has obviously had a huge impact on our business, on the industry, on our pricing, what we do. And that's all been in the last 10 years. This was from the 2006 EIA outlook calling for 150 gigawatts of new coal generation by 2030. So just keep in mind when you look at these forecasts, there are some uncertainties around them. So what's that mean now? So over the past couple years, we all know about natural gas prices. Natural gas has gotten so low that it has competed with coal. It's driven a lot of coal to become uneconomical. A lot of coal has retired because of that. And we have burned a lot more natural gas in electric generation. So here you see over the past couple years, electric generation from natural gas has exceeded coal and looks to continue to do so. And then, of course, renewable generation has increased as well. So what's it kind of look like? Again, missing a couple data points there, but you get the picture. 2018, 10 years later, a significant amount of wind in the portfolio. A forecast, just one scenario, 10 years from now, a significant amount of wind and solar, less nuclear, less coal, and more natural gas. And again, this isn't indicative of the entire industry. This is just some portfolio work that we've done here at ACES on behalf of our members. Renewables over the past 5 years have grown over 500%. First, obviously, in wind, and then in solar. And that has obviously greatly impacted. We've talked about that over the past couple days, energy prices, the industry, and our mix and our portfolio and our planning. We've also seen significant coal retirements. We talked about coal retirements after the shale boom. We expected 60 to 70 gigawatts of coal retirements, which has occurred already. We expect another 40 to 50 gigawatts of coal retirements over the next couple of years. And it honestly amazes me. I've been in this business for 20 years, so I know a lot of you have been in the business a lot longer. But it amazes me that we have a current fundamental situation with low natural gas prices and low renewable prices and a drive to be green and get away from generation that has served us for many, many, many decades. And we're making the decisions quickly. So we're quickly retiring coal. You might know as well that we're retiring some nuclear. And so you see these decisions on these 50, 60, 70, 80-year assets happening quickly, which is surprising with the current market look and the uncertainty in the future. So infrastructure, we just had a group on transmission, so I won't talk about that. It's expensive. It's been driven by renewables. We're seeing a lot more distributed generation, so you're going to see transmission work around that. Harder to get humongous lines built, so that'll be a challenge in the future. Pipelines as well. I know the challenges with getting pipelines built, and we've reported on pipelines a lot over the past few years. But I was surprised yesterday when NextEra said that they expect no new pipelines out of the Northeast. That really, really surprised me. But you see such environmental opposition against it, and they take so long to build anyway. So we will see some in certain areas of the country that are a little bit easier to deal with. But on the whole, you're having much more difficulty building giant pipelines, which has an impact on supply, but it also has an impact on what kind of generation you have in your portfolio. Obviously, if you're looking at building a large combined cycle, you would need some pipeline capacity. There are still folks doing that, and we're still working with them. We're still seeing that out in the market, and it is becoming more and more challenging. Battery technology. This is a 20-megawatt battery on the south side of Indianapolis. This is a drawing of it. There are folks working on battery technology. They are experimenting with battery technology. You're hearing about it. I was joking last night that I was on a panel a couple years ago with a senior person from SPP, and one of the audience members said, hey, do you expect battery technology to be in SPP? And he laughed and said, not in my lifetime. And I said, really? It's like on all the agendas. Everything that we talk about is battery technology. Now they have 4,000 megawatts in the queue for battery technology. So you are seeing battery technology continue to grow and become a part of the portfolio. And again, uncertainty, but something that we'll continue to experiment with. And perhaps as transmission gets more expensive and more challenging, something that supplements that, something that supplements renewables as they become more of a part of the portfolio. So I would expect that we had a panel yesterday. We had the MIT guy from there, and they're obviously a lot smarter than I am on this stuff, but I expect we would continue to see technology changes that would impact that. Electric vehicles. So I was reminded, and just again, to just put myself on the spot, I was reminded about 10 years ago when I said renewables weren't going to be a big part of the portfolio. So again, wrong. I was never real bullish on electric cars. And there are a lot of forecasts out there for electric cars, and these are just a couple of them. And it comes back to electric cars are for wealthy people. Electric cars will never replace my Ford F-150. I drive an Expedition, so, you know, but I've been talking to people, and they're creating lighter cars. They're using different technology. The battery is obviously changing. And it seems to me that it could potentially be a real disruptor in the electricity industry, and not only for potential load, which I'll talk about in a minute, but also for a use as distributed generation battery source. So I believe electric cars are a thing of the future. I think it's going to happen. Again, there's a lot of uncertainty around it, but I think it's something that we need to keep our eyes on. So what's the future hold? So that's kind of where we are today and how we got there, and you've heard a lot about that over the conference over the last couple of days. So I didn't want to dig too into the details on that. Certainly, if you have any questions at the end, I can answer those. But what does the future hold? So this is the NYMEX forward curve. This is for natural gas. This is the Henry Hub price. So if you open up the Wall Street Journal or the newspaper or turn on the TV and you see them reporting a natural gas price, this is it. Obviously, at different parts of the country, it's going to be different. But the base case scenario is that we have low-cost, abundant natural gas supply. So we have $3 natural gas supply forever. That is what people are saying. That's what the forecasts are saying. That's what people are putting in their models. That's what they're making long-term decisions on. So as we move to a greener world with more renewables, we have low-cost natural gas to rely on. That's your base case. I'll tell you the risks of that in a minute, or what we see as the risks. We have declining renewable prices. So a couple years ago, you know, renewables were too expensive. We weren't going to have renewables. And then you hear the technology changes, and it changes quickly. You hear the battery costs come down, or solar costs come down on solar panels, and they have come down. And so kind of the base case thought, again, is that due to technology improvements and efficiency gains, we will continue to see low-cost renewable technology, and it will continue to get lower. So again, that's your base case. So we've got plenty of renewables, we've got plenty of natural gas. So what does that mean for power prices? That means they've gone down. So these are all the major RTOs around the country, and that dotted white line through there is just the general trend. So, low natural gas, renewables, power prices have gone down. We will utilize this to look at the forward curve, which is these are the same areas, and say we have low cost, low volatility, energy prices forever, basically. And you can go out in the market and look, and you can get market quotes and say, yeah, I can buy $30 for 10 years, and that's great. But that doesn't necessarily mean 10 years from now, this is what it's going to look like. But this is the planning. So when we're out there, we'll retire coal really quickly. We'll retire nuclear because it's not economical today based on the latest capacity market. We will have plenty of renewables. We'll have plenty of gas. We'll lean on the market, and all will be great. And that could happen. I'm not doomsdaying here and saying that that's not going to happen. That is truly a possibility as we move forward. So 10 years from now, if I'm wrong, I'll have a slightly different job and I'll report on something else. But I just want to, as we go forward, think about what you guys do in your business and the plans that you have to make and the decisions you have to make. And the folks here have gotten up here and you've come to this conference and you said, hopefully I'll walk away with something that will help me make a decision. And based on a day and a half, I would say probably not. I'm probably not going to help either, but here's some things to look at. Here's some risks. So shale gas. So we've seen this huge growth in natural gas in the United States. And NextEra talked about it yesterday. All of that natural gas came from two areas, and one of them was shale, and mostly in Pennsylvania. So as you guys talk about diversity of supply and having different resources and reducing risks and having, some optionality in your portfolio, if you think about all the natural gas that we've seen grow in the United States over the past decade, it's basically come from one state. And so it's very concentrated. The forecast is for it to continue to grow, but as you saw yesterday, the pipeline outlook is not so good. So you have an issue there where, let's say that the gas drillers are drilling in the most optimal spots and they need to grow production, and so they move out of those optimal spots. Will they see the same return on investment? Will they see the same amount of gas coming out of the ground? I don't know. We'll have to see when they do that. If they do that, will they have the pipelines to get it to market? I don't know. It's just a risk. After listening to NextEra yesterday, if those forecasts are right for pipeline development, I would be much more concerned about natural gas prices in the future than I was prior to that. Oil. So we talked a lot about oil yesterday and how much natural gas we're getting as an associated product of oil. So they go out and drill natural gas, or they go out and drill oil. They get the natural gas out of the ground. It's a byproduct, and that natural gas makes up part of our supply portfolio. Well, again, yesterday we were looking at electric vehicles. I had mentioned electric vehicles there. Obviously, one would think that if we had a lot more electric vehicles in the United States and certainly around the world, there would be less demand for crude oil. And you could certainly see a situation where at some point, and everybody always forecasts out 30 or 40 years, but we looked back at 10 and we looked forward at 10 and it changes quickly. At some point in the next 10 years, we might not need as much crude oil. Crude oil prices might drop because of oversupply. And if crude oil prices drop below $35 or $40, you could see a situation where we lose a significant amount of natural gas in the United States because it was just a byproduct of crude oil drilling. So again, not something that may happen, but something to keep your eye on. If you're looking at the news and at some point you see crude oil coming off, an oversupply of crude oil in the world, you might think that's going to impact natural gas prices. Impact natural gas prices, impact power prices, impact portfolio decisions on power supply and market purchases. Renewables are driven by regulations. So we've got a lot of talk about renewables. We've got a lot of talk about regulations, a lot of uncertainty. A lot of stuff got built because of state RPSs. I have no idea, and I don't think any of the experts here did, on what states are going to do, what cities are going to do, what the federal government's going to do. You could see a significant swing in renewable generation either way based on the regulations that come out or don't come out. So that's one thing to keep an eye on, certainly. regulations. And I was surprised talking to Josh yesterday. He lives in Boston and Massachusetts. They have a 10 cent price cap on their electricity prices, so they can raise, actually 10%, so they can raise their retail electricity rates significantly each year based on offshore wind and other things that they want to accomplish in 100% renewable. And he was talking to the lawmakers who signed this bill, who after they signed it said, now tell us what they means. And they heard price cap and thought that meant the prices were capped, but it was a 10% increase price cap. So I think there's a lot of stuff going on out there that people aren't totally sure what the implications will be, so it's a good thing to keep an eye on. And corporate demand. Certainly we've seen it in the news. We talked about it a little bit today with Google and Facebook and the data centers and all those folks wanting to be green. They're signing PPAs. They're getting renewables built. They're going above and beyond renewable energy credits, and they're actually putting wind and solar in the ground. This is certainly having an impact on the generation mix, has an impact on the markets, and could continue to push prices lower because there might be perfectly good generation for them, but they want to be associated with wind farms, so they'll have a wind farm. The economy is really good right now. So these folks are making a lot of money. They're very successful. Their customers want them to be green. Their investors want them to be green, and so they're investing it. If we had a turn in the economy, you could potentially see where these folks won't want to spend the money to do this anymore. They'll get in, cost-cutting mode, cost-saving mode. Their investors will reward them for that. Their customers will reward them for that because they won't be paying higher prices. And the demand for renewables might change significantly if something were to happen in the economy. So again, something else just to look at that could impact the overall supply-demand current fundamentals. And they're all still dependent on weather. So we typically at this conference have a speaker on weather. We did not this year, but weather certainly has become, as mentioned in the previous panel, more volatile. It could potentially have more impact to the grid and infrastructure in the future, but certainly on solar and renewable and wind. As we see more of those, it's very sunny in the desert southeast, it's windy across the middle of the country. As you see build out of renewables in other areas, it could be more challenging in the future to see that generation provide that base load mix that you'll need. So just as we gain more and more in renewables, it's going to be a thing that we're going to have to look at and kind of keep an eye on the weather and see if the trend continues with more volatile weather. So let's get back to natural gas. Reliance on natural gas is challenging. So this is a chart, I believe NextEra mentioned this yesterday. These are prices in Texas where they are drilling for crude oil. Natural gas is a byproduct. They had a pipeline issue getting that gas out. Prices are suppressed there anyway. So you can buy gas down in West Texas right now for 10 cents, 20 cents over the past couple months. You say, well, that's a great challenge to have, but it can be the opposite too, which of course I'm going to show you here in a minute. But there was a pipeline disruption and natural gas went to minus $10 per MMBTU, which is great. If there's some folks here who have bought that and burned it, if they're still in the room, they're very happy about that. But that provides challenges for future planning. And again, this is a current fundamental. This isn't something that is going to occur for the next decade. They'll build pipelines and they'll get that out of there, or there are some gas producers have reduced some of their production on the dry gas. It'll have an impact and correct itself, but it provides challenges. On the other side, there was a pipeline rupture in Canada, Western Canada, that flowed down through the western coast of the United States and impacted prices in California. Now, I know we don't have as many folks in the California market here, but it created a lot of volatility, and this is one pipeline impact. So you could see where, as we grow more reliant on natural gas across the country, events like this could have an effect. Now, is this short term or is this long term? It's kind of hard to say. I will say that for 2019, they're forecasting California energy prices to be 25% higher than they would had that not happened. So you can see this in the short term. You could probably see this in the long term too. It's just something to keep in mind as we go forward, that a greater reliance on natural gas coupled with renewables has the potential for volatility. And foreign competition matters. There was a little discussion yesterday on LNG exports. We are exporting LNG. out of the United States, of course, the Mexican exports as well. And when you get into that, you get into a global market. We've talked in years past about how the U.S. has been a domestic market, so we've kept most of our natural gas here. We started to think about importing it on large scale in 06, 07. Of course, we discovered shale, and now we're exporting it. We're doing that on large scale, expected to be about 10% of total production in the United States, and that will have an impact. So as you see the things going on in the Middle East and other parts of the world, as we become a swing supplier of natural gas to the rest of the world, if we had 20 BCF of export capacity, we could go from 0 to 20 and back to 0, and that'll certainly have an impact on the resource mix that we want to have here to have a secure supply of electricity for our customers. So that's another thing to look at. I know there was a little slowdown in LNG projects. FERC has seemed to move those along now, and then of course pricing is also an issue. But NextEra mentioned yesterday that pricing didn't really make sense right now, but I do know from talking to folks that a lot of other countries are signing long-term LNG export deals from the United States more as a security measure to have a diversity of supply and to have a secure supply versus just relying solely on price. And then there's greenhouse gas emissions. We got to talk a lot about this in the last administration. We don't talk about it as much now, but there is still the opportunity for regulation, certainly in the Northeast and in California they already are. But this is an area where certainly regulation could once again impact what the portfolio looks like, what power supply planning looks like, and what our industry looks like in the future. So I'll finish it up with load. So load growth has pretty much flattened out. As we know, there are areas obviously that are growing. And concern that I have is that once we've all decided that load growth is going to be flat forever, because again, to kind of come back to the same theme, we seem to look at current fundamentals and say that that's going to be the same as it is forever. One of a number of things could happen. Data firms are growing. So they were talking about data companies in SPP with the low-cost energy and the load growth associated with that. The cloud, where we store all the data. And I personally think that the cloud's not necessarily a good thing, because when my phone used to get full, I would delete stuff. When it's in the cloud, you just keep on saving it. So the cloud uses more electricity than Canada and a number of other countries, which is amazing to think of. This is a slide talking about I'm going green, but I wanted to focus on the fact that electricity consumption from data is huge. And I have a feeling that with all the discussion we have about using data and having more granular data and collecting more data and crunching more data and the Internet of Things and everything talking to each other, that this is an area that's going to just continue to grow. And certainly I think that when they put those centers in, there's a potential to see load growth around those. And then the next target on carbon emissions and all the bad stuff that comes out of generating energy is potentially vehicles. So we talked about cars, and I really think that we've seen a big environmental push against coal. Obviously, we all know that. We've seen a big environmental push against natural gas, which has caused the slowdown of pipelines to be built so that it makes it difficult to build gas generation. But at some point, these environmentalists are going to say, well, we've won on that because emissions are lower, or we'll continue to work on that. But auto emissions, transportation emissions are the next big thing. And you could see the exact same thing. So even if we prefer not to have a electric car, you could see such a situation where environmental opposition coupled with the right administration could lead to regulations that would require a certain amount of cars to be electric. And certainly at some point, if we forecasted flat load growth and we turn on a bunch of data centers and we all plug in our cars, that might be a shock to the system. And so it's just something else to think about on the long-term plan as we kind of look to the future and how everything's going to look. And I'll finish up with this slide. You've probably seen this slide before. This is historical natural gas prices. We've used it before. Back in the late 90s, a popular consultant amongst many other consultants at the time were forecasting, $3 gas prices forever, which is exactly what we've said now. I'll utilize this slide to compare it to gas, but you can do it with any of those. You can do it with the renewables, the cost curves, whatever you want. So we've been wrong before. I would challenge you to do three things, really, so that I did give you something, or hopefully I gave you something, other than just walking away going, great, that guy didn't tell me anything, except now I don't know what to do. I'd say keep an open mind. I talk to a lot of people who don't have an open mind, and they think that just because we've done stuff a certain way that we'll continue to do stuff that way. And I've been guilty of that myself, so I challenge myself to keep an open mind. We don't know what the future's going to hold, so I would say, the more that you can kind of think about the possibilities, the better. Next, I would continue to collaborate. We have a lot of people doing a lot of different things here in this room, in this industry. We brought in folks from California a couple years ago when we were talking about renewables and the impacts those had. Now it's happening in the Carolinas. It's spreading across the country. ACES has it in the strategic objectives of our company to get this data, analyze this data, communicate this data. So we have newsletters, we have forums, we have conferences like this where hopefully we can spread that information around. A lot of you all are doing that at your co-ops as well. And I think that the more that you work together and share information and collaborate, I heard it many, many times over the last 2 days, in the cooperative way. I think that would be beneficial for everybody, so we can all learn together. And then 3, I think I would, I'd be ready. Who knows what's going to happen? So, be ready to act. There might be opportunities. I mean, we could have a situation where we actually do need some big generation. There's a lot of private equity that we work with that are building combined cycle natural gas plants, and we've seen it before. There might be an opportunity where they turn and go chase the next dollar and dump those into the market, and you can pick one up. There might be opportunities to work with battery companies that are doing some innovation work, that are looking more for test pilot rather than a rate of return, and there's opportunity to do that. So I think if you stay flexible and you keep some optionality in your planning and your portfolio and everything we do in this industry, it'll give you a little bit more opportunity to say, there's an opportunity, I'm going to grab it. So kind of turn some of those challenges into opportunities. So hopefully you kind of take those things away. Hopefully you got something from this. I do appreciate y'all sticking around. I'm not going to take any more of your time, but if you do have any questions, I'd be glad to make something up, and otherwise I'll let you guys get to the box lunches. And it's really bright up here, so if you have a question, good. Everybody's ready to go home. No problem. All right, well, thank you all very much. Really appreciate it.